The global economy is slowing down. Again, from Washington to Frankfurt to Seoul, policymakers are pinning their hopes on a familiar tool: interest rate cuts. The thinking is simple: make borrowing cheaper, get businesses to invest again, and give households some breathing room. It sounds reasonable, but here's the question we need to ask today. Will rate cuts really save the global economy? Or are we simply delaying a reckoning that monetary policy alone can't solve? Let's unpack it. First, what's going on globally? As of mid-2025, the world economy is growing at a pace of just around 2.9%, according to the IMF. That's barely above the 2.5% threshold that economists consider stall speed for the global system. Anything lower, and we risk slipping into synchronized stagnation, if not outright recession. Several economies are already showing signs of strain. In the US, the economy contracted 0.5%, annualized, in the first quarter of 2025. That's a technical contraction. Meanwhile, inflation, especially core PCE inflation, remains stubborn, 2.7% year-on-year as of May, which is still above the Federal Reserve's 2% comfort zone. So the Fed finds itself stuck. Growth is slowing, but inflation hasn't cooled enough. Now, in Europe, the European Central Bank has already made its move. In June 2025, it cut its key deposit rate by 25 basis points to 3.75%, marking the first major central bank to pivot from tightening to easing. The Eurozone inflation rate came down to 1.9% in May, finally within target, so they felt justified. But there's still hesitation, because growth prospects remain weak and inflation could rebound, especially if energy prices rise again or wage pressures continue. In Asia, things are mixed. The Bank of Korea has trimmed rates to 2.5%, trying to support an economy forecast to grow less than 1% this year. Meanwhile, China is cutting selectively, mostly via liquidity injections rather than outright benchmark rate slashing. And in emerging markets, India's central bank has nudged its repo rate lower to 6%, while Brazil is preparing for more easing amid moderating inflation. So yes, globally, we're easing, but each country is easing at a different pace, with different motivations, and within very different structural constraints. But let's get to the heart of the matter. Will it work? Here's the problem. Interest rate cuts are not magic bullets. They're just one piece of the puzzle, and their effectiveness depends on several factors. First, real interest rates, that's nominal rates minus inflation, are still relatively high. Even if the Fed cuts by 50 basis points this year, real rates will stay positive, around 1.5%, which is still restrictive compared to historical recoveries. So cuts might soften the blow, but they won't turbocharge growth. Second, transmission lags are real. It takes time, usually 6 to 12 months, for rate cuts to fully work their way through the economy. So even if central banks move now, the full effect might not show up until mid-2026. Meanwhile, trade tensions and supply-side shocks are causing immediate disruptions. For example, new tariffs announced by the US on Chinese EVs and semiconductors are already triggering price shifts and investment uncertainty. Third, global debt is high. The world's total debt-to-GDP ratio is hovering around 240%, higher than pre-COVID peaks. That's a drag on demand. Even with cheaper money, many firms and households are focused on deleveraging rather than investing or spending. Monetary easing may reduce the pain, but it's unlikely to spark a major boom. Fourth, inflation is fragmented. Europe is dealing with energy price disinflation. The US is facing tariff-induced inflation in goods. And in emerging Asia, food price volatility continues to challenge monetary stability. One-size-fits-all policy easing doesn't work in such a heterogeneous inflation environment. And finally, we need to remember history. In 2001, during the dot-com bust, the Fed slashed interest rates by nearly 475 basis points over 1 year. It helped, but also fueled housing bubbles. In 2008, even zero interest rates weren't enough. Massive fiscal stimulus was required to prevent a global depression. In 2020, the pandemic shock brought us ultra-low rates and quantitative easing, but the real recovery only kicked in with trillions in direct government support. The lesson is clear. Rate cuts are necessary, but never sufficient. So what would a more complete recovery strategy look like? First, we need policy coordination. Central banks can't operate in silos. If the Fed stays hawkish while the ECB cuts aggressively, we could see currency swings that undermine the intended effects. Coordinated forward guidance can reduce market volatility and ensure smoother capital flows. Second, governments must step up on the fiscal side, but wisely. Targeted fiscal support, like green infrastructure, affordable housing, or productivity-enhancing public investments, can complement rate cuts without stoking demand-side inflation. Third, we need to tackle structural bottlenecks. Supply-side reforms like easing trade restrictions, streamlining logistics, and investing in digital and energy infrastructure are crucial to reduce inflationary pressures and restore productive capacity. And fourth, debt sustainability must be prioritized, especially in emerging markets. With U.S. interest rates still high, many developing economies are struggling to service dollar-denominated debt. Institutions like the IMF and World Bank should expand their emergency credit lines and offer concessional financing to prevent another wave of sovereign defaults. In short, the global economy is at a critical juncture. Rate cuts can help cushion the fall, but they are not a cure-all. Without stronger fiscal tools, better international coordination, and long-overdue structural reforms, we risk entering a new era of low growth, persistent inflation, and geopolitical uncertainty. So, will rate cuts save the global economy? They'll help buy time, but they won't buy a miracle. If you found this breakdown useful, hit the like button. Subscribe to Economicast for more expert takes on global economics, and let me know in the comments, what's your take? Are central banks doing enough? Or is this déjà vu from 2008 and 2020? Until next time, keep questioning, keep learning.